The Federal Reserve holds the key to interest rates, but will they choose to unlock a stable economy or unleash economic uncertainty? Hello and welcome to my channel. The Federal Reserve plays a crucial role in our economy, and one of the most important tools they have at its disposal is the ability to raise interest rates. But what exactly happens when they do? A rate hike can have a ripple effect throughout the economy, affecting everything from mortgage rates to stock prices. In this video, we'll take a closer look at the potential impact of a rate hike and explore what it could mean for you and your finances. So, stay tuned to find out the possible outcome of the Federal Reserve's interest rate hike. Imagine a giant lever that controls the flow of money in the economy. That's the Federal Reserve, also known as the Fed. This independent government agency, created in 1913, is responsible for maintaining the nation's financial stability and implementing monetary policy. Think of interest rates as the price of borrowing money. The Fed has the power to adjust these rates, making it either cheaper or more expensive to borrow. When rates are low, individuals and businesses can afford to take out loans and spend more, leading to economic growth. But when rates are high, borrowing becomes less attractive, resulting in less spending and slower economic growth. The Fed's ability to adjust interest rates is a powerful tool that it uses to shape the economy. It's like a conductor leading an orchestra, with each adjustment bringing the economy closer to harmony. Given the Fed's role in implementing monetary policy and its ability to adjust interest rates, it is important to understand how interest rates can affect the economy. Interest rates play a crucial role in determining the health of the economy. When interest rates are low, borrowing money becomes cheaper, which can lead to increased spending and more economic growth. Low interest rates make it easier for individuals and businesses to obtain loans, which can help them invest in new projects, expand their operations, and hire more employees. This increased spending and investment can help boost economic growth and create jobs. On the other hand, when interest rates are high, borrowing money becomes more expensive, which can lead to decreased spending and slower economic growth. High interest rates make it harder for individuals and businesses to obtain loans, which can lead to decreased spending and investment. This can lead to a slowdown in economic growth and job creation. High interest rates also make it more expensive for consumers to borrow money for big-ticket items like cars and homes, which can dampen consumer spending and slow the economy. Interest rates also affect the value of currency. When interest rates are high, the currency tends to become stronger and more attractive to foreign investors, which can lead to an increase in demand for the currency and a rise in its value. Conversely, when interest rates are low, the currency becomes less attractive to foreign investors, which can lead to decrease in demand for the currency and a fall in its value. As a result, the Federal Reserve plays a crucial role in adjusting interest rates to influence the economy and, in turn, the value of the currency. The Federal Reserve, or the Fed, plays a crucial role in adjusting interest rates to influence the economy. The Fed sets interest rates through the use of its monetary policy tools, such as open market operations and the discount rate. Open market operations are the primary tool the Fed uses to adjust interest rates. The Fed buys and sells government bonds on the open market to influence the money supply and interest rates. When the Fed wants to raise interest rates, it will typically sell government bonds on the open market, which reduces the money supply and increases the cost of borrowing. On the other hand, when the Fed wants to lower the interest rates, it will buy government bonds on the open market, which increases the money supply and decreases the cost of borrowing. The discount rate is another tool that the Fed uses to adjust interest rates. The discount rate is the rate at which banks can borrow money from the Fed. When the Fed raises the discount rate, it makes it more expensive for banks to borrow money, which can lead to higher interest rates for consumers and businesses. The Federal Reserve also uses other monetary policy tools, such as the reserve requirement, which is the amount of funds that a depository institution must hold in reserve against specified deposit liabilities, and the interest on excess reserves. The Fed's ability to adjust interest rates through these tools allows it to influence the economy and ensure economic stability. The Fed must carefully balance the need to control inflation and stabilize the economy with the need to promote growth and employment. The Fed's monetary policy decisions are critical to ensuring the stability and health of the economy, and they are closely watched by investors, businesses, and policymakers. Additionally, raising interest rates also has the potential to impact economic growth and employment. Effects of an interest rate increase. When the Federal Reserve raises interest rates, it can have both positive and negative effects on the economy. One positive effect of an interest rate increase is that it can help control inflation. Inflation is the rate at which prices for goods and services rise over time. When the Fed raises interest rates, it makes borrowing money more expensive, which can slow down the rate at which prices are rising. This is because businesses and consumers are less likely to borrow and spend as much money when interest rates were high, which can lead to a decrease in demand for goods and services and ultimately slow down inflation. However, an interest rate increase can also have negative effects on the economy. One negative effect is that it can make it more difficult for individuals and businesses to borrow money, which can slow down economic growth. When it becomes more expensive to borrow money, businesses may not be able to afford to expand their operations, and consumers may not be able to afford to buy as many goods and services. This can lead to a slowdown in economic growth and job creation. Additionally, higher interest rates can lead to a stronger dollar, which can make US exports more expensive and less competitive on the global market. This can negatively impact businesses that rely on exports and the overall economy. High interest rates can also affect the housing market, making it more expensive for people to borrow money to buy a house, which can lead to a decrease in demand and decline in house prices. Lastly, it's important to note that the Federal Reserve has a delicate balancing act to perform when it comes to controlling inflation and promoting economic growth. One powerful tool at their disposal is the ability to raise interest rates. However, while this can be effective in controlling inflation, it can also have a negative impact on borrowing and economic growth. When the Federal Reserve raises interest rates, it makes borrowing more expensive, which can make it more difficult for businesses and individuals to access the credit they need to grow and invest. This can also slow down the economy, causing a decrease in employment and potentially even a recession. However, it is not always as simple as raising interest rates causes a slowdown and cutting interest rates causes a boost. The effects of interest rates changes depending on the current economic conditions. For example, during a recession, raising interest rates could make the situation worse, and cutting interest rates could help the economy recover. So, the Federal Reserve must tread carefully and take into consideration a wide range of factors when deciding whether or not to raise interest rates. They must weigh the potential benefits of controlling inflation against the potential cost of slowing economic growth and employment. It's a challenging task, but one that the Fed takes on with great responsibility to ensure the stability of the economy. Well, that's all for today. I hope you found this video informative and helpful in understanding the impact of interest rates on the economy and how the Federal Reserve plays a crucial role in adjusting them. Don't forget to like and subscribe to my channel for more informative videos like this one. Thank you very much for watching.